3, 2, and 1. Hello, everybody. Welcome to another Capital Gains Tax Solutions podcast, also streaming on YouTube and Expert CRE Secrets. And this is a kind of a special, I guess, podcast class like webinar, because I'm excited to present along with Colony Hills Capital, Addison at Princeton Meadows Multifamily Investment. It's in New Jersey. And we're going to dive right in with the leaders of Colony Capital, Julian Vogel and Glenn Hansen. Glenn and Julian, how are we doing today, gentlemen?
Fantastic.
Yeah,
thanks for having us.
Thanks.
Absolutely. And so this is 440 units in Plainsboro, New Jersey. And I think it would be great to start before we get into the details of this. Maybe Glenn, you can tell a little bit about Colony Hills Capital, the background, the how everything got going there. And just a little bit of your guys' track record, and then we'll dive in with Julian on some of the details on this new investment opportunity. So, Glenn, take it away.
Yeah, happy to. Thanks for having us on the show, Brett. It's a pleasure. To answer your question, I'll be brief. Colony Hills Capital, I founded the company in 2008, and we've been focused on our thesis, which is to find and purchase multifamily properties nationwide, anywhere that we can get a 20% IRR and 8% cash on cash on the initial underwriting. We focus on off-market transactions in primary and secondary markets. And to date, we've purchased over 11,000 apartments and closed out of $500 million in deals at this point, with an average levered IRR of 36%. No losses to date, and I'm pretty pleased with that, as you can imagine. And with that, the rest of it is just our shoulder to the boulder, pushing it up the hill every day, finding deals, finding money, working with guys like you, and having fun.
Absolutely. And Glenn and I had I had the pleasure and honor of meeting Glenn at a DLP Capital event. This is back. This was in Utah. It was the Best Ever Real Estate Conference, and we had a great dinner there and hung out. And then we also had a chance to another event, which was in New Orleans, and spent some time together. So got to know Glenn personally, and excited to present this for them to present this opportunity. But I love the way that you've stuck to the thesis. You focus on multifamily value add, 8%, 20 and then 20% IRR, and you've done it since 2008, and you've done it over 11,000 units. And so this is a team and an organization and a group of specialists who've delivered, which is fantastic. That being said, I'll introduce or have Julian Vogel introduce himself. Julian, introduce your role there at Colony Hills Colony Hills Capital, and then let's dive right into the deal after that. Okay.
Sure. So I'm the fund manager for the company. Basically, my job description is twofold. I determine the strategies for our funds, and then I manage the capital raise and the compliance. And then I also manage the debt and equity orchestration, let's call it, on a deal-by-deal basis. So I source all the debt and the equity in-house. And both jobs are a lot of fun.
Absolutely. And you guys are both in the great state of Massachusetts. I have some good family out there in Concord. And so I think about an hour and a half out of Boston, which is fantastic. So all that being said, let's dive right into the deal. Addison at Princeton Meadows. I'm going to give you screen share capability. Julian, if you want to screen share at any point, you can in and out screen share, but take it away, Julian.
Sure thing. Looking for, here we go. Okay, can you guys see this?
Absolutely.
Yes, got it.
Okay, great. So I'm going to skip the introductory slide. I'm also going to skip around this book a little bit as I talk. And I'll just jump right into the opportunity. So the opportunity for this deal starts with the seller. This is a joint venture. The seller is a joint venture between Goldman Sachs and KRE. And they put $12.8 million into this transaction. And they, besides for the purchase price, obviously, and they've owned it for 5 years. They renovated 85% of the units. They redid the exterior and the roofs of the property. And then middle way through COVID, Goldman Sachs self-imposed a self-restriction or a moratorium, better said, on rental rate increases and evictions across all of their joint ventures. And so this property had just gone through 85% renovation of the units, and then they couldn't even raise rents because of that self-imposed moratorium. Fast forward to September 2022 or 2023, excuse me, that moratorium, or 2022, that moratorium burned off, and they're starting to market or increase the rents to our targeted premiums. So they're also proving out our case study here with this deal. We were able to get this property under contract through an off-market process at 115 million, which is about a 5.5 cap on a trailing 3-month income annualized, with a tremendous amount of dormant value. I mean, 85% of the units are turnkey. We just mark to market those units, and most of the value add is already accomplished. We'll also be adopting pre-approved renderings and permits to redevelop the clubhouse in the middle of this property. Right next to the pool area is a pretty small little clubhouse that we're going to see in a second, that we're going to demolish and redo into a brand new leasing center, fitness center, and rentable party area. And the last 15% of the units will also renovate. And so by the time we've finished that, this property will have had a full renovation and will arguably be the leader within its comp set, within its vintage set in the submarket. So that's the real estate history. As far as the market goes, Princeton, New Jersey, Plainsboro, very affluent, average median incomes of 200,000 plus or minus, very difficult to build in Princeton, Plainsboro. And so the supply of housing there is grossly constrained. Not a lot of trades, and most people that live there own. And so having a supply constrained market with affluence is a equation that we very much like, right, in multifamily real estate or in housing. And so the rents, I'm not going to jump into all the detail on each page. I'll just stay high level, but the rents are on average $400 below all of our comps. And here's some pictures of what the property looks like. You know, they did a wonderful job. This is the model unit, but all of the renovated units look like this.
By the way, beautiful property. And if you're just hearing this, maybe not seeing it, you can go to our YouTube channel, Capital Gains Tax Solutions, or Expert CRE Secrets. Expert Secrets, Expert CRE Secrets for our other YouTube. But it's a beautiful property. And by Princeton, I'm thinking, you know, I'm from California now. I'm in Florida. Okay, so I'm looking at the map here. How far from Princeton University, and talk about kind of the average household income and the radius here. This looks good, Julian.
Yeah. So here's the average income. This is from Tactician, which is a third-party data source that we use for all of our properties to give us demographic data. So you can see, you know, 200K plus or minus around the property, and it's a snowball throw from Princeton University. You can see on the map right over here.
Excellent. It looks like also just bigger picture. It's halfway between New York and Philadelphia.
Exactly.
Talk about maybe the strategic part of that, Julian.
Yeah. So you have commuters who are either commuting to or fro New York or Philadelphia. You also have people who are heavily invested into medical and life sciences, doctors, medical staff at Carnegie Center, obviously education with Princeton University. BlackRock has a satellite office there, Santander. So you also have Siemens. You have financial services that are nearby, so you don't necessarily have to commute. And then you have tremendous schooling, fantastic schooling for young families or families who move to the area specifically for that reason, which is another driver for this asset. If someone can't afford $1 million house, I'm jumping back for a second, average housing, 688,000. It's more like $1 million these days. But if they can't afford to buy a house, where are they going to live? So one of their options is this property, if they want to take advantage of that schooling.
Wow, that's fantastic. And I also love that you did say that the upgrades that the old previous owner had completed already, and they were constrained by the rent control with the COVID lockdown, and so 85% of the units are turnkey, and there's a lot of dormant, value that are just lost to lease and just turning of the units.
Yep.
So, curious on the current occupancy and the average turnover per year. Do you kind of have some of those numbers, Julian?
95% occupied, and higher at times. There was times when we were in our due diligence process where it was 99%. And then average turnover, we typically see a third of the rent roll turnover on all of our assets on a per annum basis.
Excellent. So keep going. I'll let you keep going here, and I'll just kind of jump in here and there.
Yeah, I'll skip over the slide. Here's details on Princeton Plainsboro if anyone wants to read through. And this is a snapshot of the historical CapEx that the seller had done. You can see $8.5 million spent on unit renovations with a total of 12.8. And here's a snapshot of our planned CapEx. So the biggest line items here you're going to see is the clubhouse, which I already mentioned. We're going to see a rendering in a second, which we have about $2 million budgeted for. And then classic units, we are going to be spending $25,000 a unit on those, just to create a uniform quality in the rent roll. And here's a rendering of the clubhouse that I keep mentioning. So it's just going to replace this property right here. We'll resurface the pool area, refurbish it, create some splash pads. We're going to redo the basketball and tennis court. There'll be a half basketball court, pickleball, volleyball. Somehow, some way, it's all going to fit in there. We actually used AI to determine the layout for that sports court, which is pretty cool.
It looks fantastic, by the way. If you're not seeing it on video, you can go to the YouTube channels. It's fantastic here. Keep going, Julian.
And here's our rent comps. So here's Addison, our subject property. And it's important to notice that you have 1, 2, 3 properties, 3 comps that haven't been renovated, right? Deer Creek was renovated in 2000, but that's 23 years ago. The closest or most newest renovated property here is the Crossings, and that was in 2019. And look at the delta between our 1 and 2 bedrooms and the comps here.
Fantastic.
$560 delta, right?
Yep.
Is $670 delta or $600 delta. So it's pretty glaring. So important to note that we're not revolutionizing the rents when we do mark to market. We're not going to lead the market. So our targeted rents are right here for a 1-bedroom, $20.50, a 2-bedroom, $25.75, which is just below some of our comps, slightly above some of our comps. But you have to remember that we're going to have a fully renovated asset, whereas these properties are classic. And so arguably we should be leading the market, but we're not underwriting that.
Let's talk about debt, right? Because debt's so important, right? Because one thing to have the rent increases and the occupancies, which across the country we're seeing that to be very solid, right? For a lot of states and cities, but the key is the debt. So let's talk about the debt, because you can have a great deal, or you can have a good property, performing property, but bad debt, and that equals a bad deal. So talk about the debt structure here, Julian.
Yeah, so I'll skip ahead for a second. So apologies, but these two numbers on here needs to be updated, because these were just locked in on Friday and this past Friday. So our proceeds are actually $75 million. Our interest rate is 5.29% fixed and locked. We're closing Tuesday of this coming week, so we're pretty close to the end here. 6 years of interest only, and about 65% loan to value, a little less. And that's through Freddie Mac.
Which, considering, it's not so bad, right? 5.29 fixed for 10 years, 6 years IO, right? 65% LTV. I think that's a big win given where we've been this past 12 months. Any other thing to talk about that debt there? Because that's pretty attractive.
I don't know anyone else locking in that sort of rate right now. The reason,
No.
the way that we were able to get that is we signed our loan application 4 months ago, right before a hike in spreads. And then we basically bit our nails for 4 months watching the treasury go up and down before we finally locked.
Wow. Yeah, you guys did that well. Glenn, do you want to add anything to that? Because that's just such an interesting part of this whole deal.
I'll say that a week ago, we locked Friday, but if we had to lock the previous Friday, we would have lost 4 million in proceeds. So in 7 days, we had a gain of 4 million, including some other changes in the stack, but really helped the performance of the deal right as we came into a lock.
Sounds like good instincts to me, Glenn, and some a lot of experience to be able to do that. Great job by you and Julian, whoever made that final decision. So keep going, Julian. We have about 8 minutes to wrap this up before I got to jump on another one. So just FYI, but you can keep jamming through this.
Yeah, sure. So I'll jump here. So the returns for the GP equity. So this is our JV partner is a group out of Philadelphia. This is our third deal with them. They're providing $35 million. And so the offering here is for a co-GP stake in the deal. Colony Hills is bringing $8 to $9 million to this deal, closer to $9 million. And so we have a little sliver open in this deal out of the 11.6 that we were originally offering to our network. We could probably take in another $2 to $3 million right now. And the forecasted returns for that $2 to $3 million is a net 24.75 IRR and a 2.77 equity multiple, with a projected 8.23% average cash on cash on a 5-year hold. And that's assuming we use an exit cap rate, meaning when we sell, of 5.25 in year 5, which we feel is conservative. And the reason we feel that's conservative is if you look at the SOFR curve coming down. I've learned to respect and appreciate those forward-looking curves. Obviously, no one can tell the future, but I think most specialists would agree that sometime between now and the next 5 years, rates likely come down. But even with that conservative 5.25 cap rate, you can see what the returns look like. So I'm going to jump with only 8 minutes. I'm going to jump to the schedule of returns here. So this is for the 11.6. The first year yield is projected to be 3.4%. Year 2 is 6%, and year 3 is 11.9. We're funding a $2 million distribution reserve to provide yield to the GP equity during the ownership of the deal. And so that $2 million gets drained in year 3 in totality. And so in year 3, you have a combination of organic cash flow and the last bit of that $2 million of distribution reserve, which is why in year 4, it drops to 9.8%, because now you're just getting organic cash flow to the GP.
So curious on that, Julian, because that may be new for some people who are listening to this. Is that essentially you guys are like pre-funding the cash flow and then you'll make it up on the back end if and when it closes and you guys perform? Is that what you're saying there?
Yep, exactly. A lot of investors are more sensitive to yield than IRR these days. They'll take IRR, but they feel that yield is more of a sure thing, and it's more of a sign of the health of the asset.
Yep.
And so it's something we've done on a couple deals.
Excellent.
And that's the story. That's the pitch.
All right. So a couple questions. You can stop screen share, then we kind of go through this. So Glenn, if I had $1 million right now, right, and I'm looking to invest into this property, and given you guys' track record, past performance is not a guarantee of future results, but what would you say my return would be in the 5 years if you were to sell at that number? What would that look like, Glenn? What could I expect? My $1 million plus those cash flows, and then what at the end?
Well, at the end, in total, it's 2.5 multiple. So that sums it up pretty simple. And then with the current pay, early on that helps create some comfort for people who are living on a fixed income.
So $1 million goes to 2.5 million. Is that the right way to think about that?
Yes.
Okay.
Yes.
Is that including the cash flows that we've collected over those 5 years, right? So it's including that,
Yes.
right? So it was
all
about,
in.
like it's like the 3.8 and then the 6 and then the like 11 and a half, 11.8 and then like the 9. So all that, because the cash flows, $1 million now, you start getting cash flows, in the first year. Now talk about quickly, Julian, just cost seg, if you guys are doing cost seg and the bonus depreciation, are you guys taking advantage of that, or what's your thoughts on that?
Of course. We do that on every deal. Cost segregation studies, something we're going to start doing is having them, we're going to have a third party do an estimate pre-acquisition so we can have a more defined answer for investors before we acquire a deal. But we've had deals that have had 100% tax loss year one. So if someone puts in 100K or $1 million, they have $1 million or 100,000 of tax loss that first year. It typically depends on the vintage of the property. So I've seen it range from 80 to even above 100% loss, from those cost seg studies.
That's fantastic, right? That means the cash flow that's coming out, right, is going to be offset with the paper loss,
Exactly.
which is what we love here at Capital Gains Tax Solutions, being very tax efficient with all of cash flow and tax flow, right? So it's combining the best of both worlds, and a deal that makes a lot of sense fundamentally, sub-market wise, even larger market wise. I don't see any weaknesses in this deal. Glenn, if you had to point out one thing to be aware of, or the thing that you guys are watching, anything that comes to mind, but it just seems like a solid, great business plan here.
Yeah, we've scrubbed it hard. There's nothing that we know of lurking in the background. And to that point, we're putting millions of dollars of our own capital in. Julian, with the fund and our own investment, what are we anticipating having in this transaction at this point?
9 million.
Okay, so that's a pretty good indication right there that we believe, right?
Absolutely, Glenn. By the way, Julian, what's the I know it's about 2.77 is the multiplier, is the estimate there, right?
Mm-hmm.
What is the GPLP split, right? What does that look like? What's the pref? Do you guys have that? I don't know if we mentioned that, maybe just mention that really fast here.
Yeah, I skipped over it because I didn't want to chew up too much of the time, but I'll get right into it.
Yeah.
So during the ownership period, there's a soft priority return to our JV partner of 8.5%, then 8.5% to the GP equity, and then thereafter during the ownership period, the GP equity gets a 60% promote off of the LP on cash flow. So if $100,000 was going to go to the LP, they only get 40,000, and 60,000 goes to the GP instead, after an 8.5 and an 8.5 is accomplished. On sale, debt is paid off, cash goes to the LP equity until they hit a 12.5, then to the GP equity until we hit a 12.5, and then we get a 60% promote off of the LP position until a 15 IRR is achieved, and then it's a 75-25% split. Very healthy promote structure for the GP. I don't see this sort of promote structure often. I don't know about you. And then for the co-GP position, right, the 11.6 that we're bringing into the GP equity, Colony Hills is asking for a 15% promote after all members have achieved a 10 IRR. So once everyone's hit a 10 IRR, then it's a 15% promote.
Excellent. We are out of time. Great job, guys. Julian, if people want to find you and Glenn, what's the best place for them to find you?
Email julian.vogel@colonyhillscapital.com.
Excellent. And that's spelled VOGEL, and Julian's just like it sounds. And
with an
and
A instead of an E. A lot of people.
Oh, E there, yeah. VOG.
No, it's a JULIAN instead of an EN.
For
Vogel,
Julian.
VOGEL.
Got it. Okay. Yep. And by the way, it is spelled correctly on the other screen, so you guys can't see that. It says pop up here on YouTube. And so if you guys want to learn more, go to colonyhillscapital.com, connect with Julian and Glenn, and take action. If you're looking to exit a highly appreciated asset and you're looking for ways to defer capital gains tax and then invest into investments just like this, Our company can help you build an effective capital gains tax exit plan. You can go to capitalgainstaxsolutions.com. Look for the new book that just got released on hit number 1 on Amazon, which is Building a Capital Gains Tax Exit Plan. Check that out. We so appreciate you watching this, and we will talk to everyone again.